market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, China's top leaders have made strengthening domestic demand their top economic priority for 2026. During its December huddle, the Communist Party's decision-making Politburo had reiterated the need for more proactive fiscal policy and moderately loose monetary policy. Now, for more on all of this, we're joined by Bloomberg's Jill Deesis. Jill, what kind of tone is China actually setting for next year, and can we expect any stimulus?
Well, Francine, I think what you're looking at here is what the statement tells me is that we're looking at sort of moderate expectations for next year, a measured approach potentially to stimulus. So I wouldn't expect anything that's like extreme super bazooka style. But China obviously is acknowledging with the statement that that idea of boosting domestic demand continues to be a really critical one for the Chinese economy. Remember, concerns about sort of a lack in consumption this year has been really dogging this economy, particularly when you're framing it against what the overall trade environment looks like. Obviously, China's exports have surged this year, but there's a lot of questions about how much momentum that can ultimately maintain going into 2026. One thing that really stood out to me with the statement was that in addition to really these reiterative policies, including that idea of keeping a moderately loose monetary policy stance, was the return of some language referring to cross-cyclical adjustments. That's a phrase that normally appears when China's talking about taking the longer view. So clearly there's a need to balance the idea of sort of short-term, needs for the economy with what their overarching longer-term views actually will be.
So, Jill, what kind of economic challenges is China still facing, and I guess trends that could accelerate in 2026?
Yes, Francine. Well, I do think that when it comes to consumption, so again, hinting at this idea of those concerns about domestic demand within China, that continues to be an issue. We also saw some significant challenges to investment this year start to weigh on economic growth. So I think that's one thing that China is going to be looking at. And again, I think when you're looking at the trade environment, maybe there's a trade.
I think we're just having a couple of audio issues with Jill. I don't know if it's only me, but Jill Deesis from Hong Kong laying out some of the groundwork that, of course, China has to do into 2026. We'll get back to Jill a little bit later, maybe when we can reestablish a connection. Now, the European Central Bank, Isabel Schnabel, says she's comfortable with investor bets of a rate hike. The executive board member is warning of risks to the economy and inflation. Meanwhile, in the U.S., Fed Chair Jay Powell expected to push through another quarter-point interest rate cut on Wednesday, despite growing unease among fellow policymakers that inflation remains too high. I'm delighted to be joined by Anne Walsh, Chief Information Officer at Guggenheim Investment, who joins me now. Chief Investment Officer, not Information Officer. And do you want a new title? Anything goes.
I can do lots of things.
What would you like to be? Okay. And I'm so happy to speak to you because actually it's all about the Fed this week.
Yes, it is.
The Fed on Wednesday, you're expecting a cut. Is it a done deal? Markets are pricing in like an 80% chance of a cut.
Well, Francine, it's great to be with you. It is really baked in at this point in time. The markets have given the Fed opportunity to go ahead and cut that 25 basis points. We had been predicting it for quite some time that we were going to see 75 basis points of cuts this fall, which is what we're going to get, and I think for all the right reasons. The Fed, notwithstanding the hawkish tenor that's coming out from some Fed officials, is really trying to get to a neutral rate of interest rates at the Fed fund. So our view is that's about 3%. Which means they have the room to cut this week, and they have the room to cut some in 2026 as well, to get to neutral.
How much does it depend on who becomes Fed chair?
Well, I think considering all the candidates for Fed chair at this point in time are all pretty dovish, I think that it really is going to be part of the trajectory. And the Fed chair, when they come in or when they're named to come in, I think that's still going to drive that trajectory down to that neutral rate of interest. Question is, do we go through that? In other words, do we go to 275 on the neutral rate? And right now, we're saying 3%.
And overall, what kind of U.S. economy do we have now? Is there a worry that actually the U.S. consumer weakens, that we're going to have more defaults? When you look at the K-shaped recovery, I mean, a number of things could actually go wrong.
Right. We've been in a bifurcated economy for the last 2 years at least. And that is small businesses, low-end consumers have been struggling as interest rates rose, inflation rose, and the cost of living offset their ability to gain additional income benefits. The larger part of the economy, those companies that have access to capital, as well as high-end consumers, have not actually suffered because of the wealth effect that's come from the stock market appreciation and value appreciation in real estate and other assets. As a result of this, the cuts in interest rates, while they won't have a meaningful impact in terms of the broader economy, I think, unless we were to get to stimulative levels of interest rates, which is not what we're predicting, but it will help that part of the economy that's interest sensitive a bit. And I think that's what we can all look forward to in terms of helping that part of the economy. And then it stabilizes. So essentially what we're looking at is an economy in some level of equilibrium. We're projecting a 2% approximately GDP growth level in 2026. That's a long-term average. 2% real GDP in the U.S. is really a long-term trend line. And as a result, that, again, should stabilize, get us to an equilibrium state, a 3% neutral rate on Fed funds, and it looks like a pretty good potential year for 2026 from that perspective.
What about inflation? So the market has largely looked through, actually, a lot of the tariffs and trade. Does it come back with a vengeance in 2026?
So inflation's interesting. I think, generally speaking, we can see that some inflation levels are going down. In particular, one of the elements of inflation, which is rents and owner equivalent rent, particularly in CPI, has been stubbornly high. It's starting to finally decline. The headwinds, of course, still continue to be costs of insurance and other costs to the consumer. But that's going to be it's a big component of CPI, and so it's going to be a very substantial tailwind. Having said that, let's go old school for a minute. Money supply is actually rising in the U.S., and that has a stimulative effect. It also has an inflationary effect. Very few people talk about it. And additionally, the Fed has determined that they've stopped quantitative tightening, and in fact may be starting to re-increase the balance sheet, which also has a stimulative effect. So they're going to have to watch inflation, less so from a tariff perspective, but more so from these sort of old school monetary policy actions. That's something we're going to watch.
I don't know how to read AI, whether it's a valuation story or of actually the kind of impact it could have on inflation longer term. So do you worry, first of all, about valuations in 2026?
I don't necessarily worry about valuations just in the short term.
Right.
I tend to think of this being a very substantial macro phenomenon that's going on in the backdrop, if you will, a technology supercycle. Yeah. And as a result, it's going to have a very long-term effect. Historically, technology is overpriced in the short run and overpriced in the short run and underpriced in the long run. And as a result, the valuations will take a long time to play out. Short run, we're in a bit of a reflationary world, but not like 4%. I mean, just like around a 3% risk, only because there's a big build out that has to happen to get us to the infrastructure that we need in order to support this technology supercycle.
But the deployment of capital in this space is nothing like I've ever seen before. How problematic is it that actually there's a time lag of the deployment of capital for everything from also the data centers and the fact that you don't get returns for a lot longer? Well,
and I think there's sort of two chapters to this, maybe multiple chapters, but at least in terms of a very high level. You have the immediate investment that's going on in the infrastructure, the data centers, the chips, but you have the investment that's going to be taking place in the broader economy in order to make use cases work for artificial intelligence and this technology build out. And by the way, I don't want to limit it just to artificial intelligence. Robotics, communications, there's a whole lot of dynamism that is happening in technology right now. All of that will play out over the course of time. And as those use cases and as those use uptake that occurs, then I think we'll start to see the productivity gains that will offset those costs in the longer run. So I think there's a real benefit here, and I worry a little bit less about the short run. And I also very much dispute the belief that this is a dot-com bubble valuation risk. I don't see it as that. We have real earnings in this cycle relative to the late 1990s, and I think that's fundamentally, we've got a better narrative here than we did then.
How do you construct the ideal portfolio? I mean, there's a number of worries about geopolitics. It could be with China. There's a number of concerns in Europe that actually the U.S. just sees Europe as redundant and over-regulating. So can you see value in stocks in Europe, or actually do you wait for this to all play out?
Well, I think if investors waited, then they might miss opportunities, too. I believe in a diversified portfolio. It mitigates risk, but it also allows for the opportunities. And not just in Europe and here, but also in Asia. For example, Japan's still got a pretty good story happening there. So moving away from the U.S.-centric and U.S.-only investing, I think that's prudent at this point. And I do think that as particularly the regulatory story in Europe is going to take a while to evolve, but it will. And defense investments continuing. And so there are geopolitical dynamics that are positives for equity investors.
So again, I mean, there was quite a lot of news with Japan and actually bonds really on the move last week. And again, this week we have this Bloomberg scoop with the ECB's Isabel Schnabel about actually the next rate move in Europe being up. Do you play it from, the currency or bond level, or do you actually go into equities?
I think you probably go into equities in Japan and in the EU area relative to bonds at this point in time. There's a lot of noise in particularly out the yield curve in whether or not we have inflation, whether or not we're going to see rate hikes. I don't really see much movement. I'm in the camp of being a little skeptical. Bank of Japan will raise rates a bit more, but I'm not sure that the headwinds that they have for relative to demographics and other really long-term macro trends work to raise rates too much. I would say the same thing for different reasons here in Europe, because the story of stagnation is still looming, and rate hikes, sure, you could talk about they could happen. I'm in the camp of being a bit more skeptical. And
when you look at Bitcoin and you look at gold, what are these two asset classes actually? How do you tell some of the your investors to play with those?
Bitcoin's interesting. I tend to think of it as a proxy for risk appetite as much as anything. And the fact that it's sold off of its highs quite considerably tells me that there is nervousness. Market sentiment is edgy at this point in time, and there is a risk that some investors start to really pull back. So I think that's what that's telling us relative to gold, which is still an alternative to other dollar-based investments from non-U.S. investors in particular who are looking to diversify away from U.S. Treasuries, which I think is also keeping the long end of the U.S. Treasury curve sort of in a range. On the 10-year, for example, we're between mid-threes and mid-fours. We're going to stay there. We're entering year 4 of that trading range. I think that continues. Gold's an investment alternative, and I think precious metals, whether it's gold or silver, still have more room to run as a result of being an alternative investment choice, not necessarily just a measure, as it historically has been, of inflation risk.
And is there anything that you think is mispriced at the moment?
I think there are areas of value that investors can take advantage of. I think infrastructure there's a huge need for infrastructure. It's not just technology infrastructure, but it's across the board, energy and transportation and the like in the U.S. and in other parts of the globe. The build out that needs to happen is important. Real estate in some areas is undervalued. So hard assets offer a lot of value. And believe it or not, in the U.S., investment grade fixed income actually offers a nice nominal return for investors. It's not a bad place to be. It's, like I said, it's sort of stuck in a trading range. That's fairly stable.
And what a pleasure to speak to you today on this Monday morning to get us started for a big week. Anne Walsh, Chief Investment Officer at Guggenheim Investments. Now, coming up, Smith & Nephew unveils a new strategy after completing a 3-year turnaround. We'll be speaking with the Chief Executive next, and this is Bloomberg. Conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Ray Dalio, the founder of Bridgewater Associates, says investors aren't paying enough attention to the debt dynamics playing out in the world. He spoke to us in Abu Dhabi.
We are having too much debt. Now, this is not just the United States. You're seeing this in England. You're seeing this in France. You're seeing this in China. You're seeing that dynamic. so that they can't increase the debt the way they did before. And then related to that is the politics. But when you have these large wealth gap differences, who has the money? And when there's the accumulation of a lot of wealth that then isn't taxed, there's a tendency to want to tax that wealth. And that creates bubbles. In other words, when wealth is very different from money. In order to spend money, you have to sell wealth and get money. And when there's a lot of wealth that needs to be sold. So quite often interest rates play that role, but you could see wealth taxes play that same role, meaning the need to sell that. And that creates a bubble. So we have a debt bubble going on. We have that other kind of a bubble going on in the economy and related to politics. And then, of course, geopolitics. Capital flows and trade flows are different because we have a world in conflict. And in that world in conflict, no country could be secure. So that's why the United States wants to build self-sufficiency in these areas. Or China, which is that model where China would export to the United States and earn money and then invest in bonds, is no longer a viable path because the Chinese worry that they won't get paid on their bonds like the Russians don't get paid on the bonds. So that dynamic is what is behind what's happening, and it's becoming more precarious as we go forward. Like if we go into the 2026 elections, it's likely that the Democrats will take the House. Significant possibility. If that happens, the political conflict will continue to be more difficult, and so on. And that's creating this risky environment. Particularly also, debts are maturing. So you have to roll over your debt at a higher interest rates. This confluence of factors is making the environment more risky as we're going ahead.
Well, that was Ray Dalio, the founder of Bridgewater Associates. Now, Smith & Nephew is planning to pare its portfolio further as part of a new effort to boost growth. The medical technology company has also unveiled a new strategy following the completion of its 12-point plan transformation. Well, Deepak Nath, the chief executive, is with us now. Deepak, thank you so much for joining us. I mean, first of all, I know this was a thoughtful plan. The end game is to be, I guess, more nimble in the face of adversity. What does that adversity look like in 2026?
Well, Francine, first of all, thank you for having me here. It's a pleasure to be here. It's an exciting day for the company where we unveiled our new plan of RISE. It's an ambitious strategy, but it is achievable that elevates Smith & Nephew to levels that we haven't reached before. What's exciting about it is that, as you mentioned, there are significant macro headwinds that we're faced into, but we've got a plan that allows us, I believe, to navigate these headwinds and deliver what would be significant acceleration, both from a growth standpoint and actually deliver better returns than we've achieved so far. But it is built on a strong foundation. After the 12-point plan, we are now a stronger company, more agile, and actually more growth-oriented. I
mean, there's a couple of things. You know, there had been a little bit of pressure, for example, to break up the business and separate the orthopedic segment. Is it something that you're still thinking about?
Look, we feel very confident in our portfolio, and what this plan lays out is how each of our businesses plays its part in delivering performance. We expect to drive growth and above-market growth in our sports business and wound business and ENT. We're strongly positioned. In orthopedics, we've been focused in the last 3 years on addressing the challenges that have held back that business. But because of all those efforts now, we believe that we can get orthopedics growing at or above market in this strategy. So we feel that each part of our portfolio plays a role. Some parts deliver growth and above market growth. And in our case, our margin growth and our expansion in terms of return on invested capital improvement comes from, in fact, orthopedics performing well.
I know there's been questions and concerns about the sale of U.S. knee replacements. How do you address that? And actually, what exactly are the challenges?
Yeah, so over the last few years, we've tackled systematically the issues that have held back orthopedics. Some have been in commercial, others have been in operations, the ability for us to connect supply and demand, down to a very detailed level as well as we could be done. So as a result of all of those efforts, most of the orthopedics business is actually in great shape. Our hips business is in great shape. Our trauma business is in great shape. Outside the U.S., we're in great shape. In knees is the last area that is currently lagging, but the plans that we've got in place now allows us to do in knees what we've already done in hips, and that's going to come from the commercial execution improvements we've done right across our portfolio. And what we are planning to launch here over the next few quarters is further products that strengthen our portfolio, and that'll be a key kind of unlock for us as we get knees to where hips and trauma and the rest of our orthopedics portfolio already are.
How heavily invested are you in AI, and how much more will you do?
AI has been a part of what Smith & Nephew does for quite some time. In orthopedics, our robotics platform, in fact, has AI as part of it. It's what enables surgeons to develop plans, execute the plans that they've developed, and ultimately get better outcomes for patients. And that's been part of our robotic platform now that's been on the market for about 6 or 7 years. On the sports medicine side, where we enable surgeons to do soft tissue repair in the same way, and we've got AI built in to our products. In fact, we're bringing forward a radical new offering to the market called TESSA. It's a new paradigm of facial surgery that allows sports medicine surgeons to do something they've never been able to do before. And that's got AI built in, the way we process images and the way we allow patients, surgeons to actually perform their surgeries better. So AI has been a key part of our product offering. But as with other companies, we're trying to use AI now to make ourselves more productive, more efficient. And there we are on a journey just like the rest of the world is in terms of how we make, essentially drive more productivity across the organization.
Deepak, we've seen a lot, some actually companies listed here in the UK wanting to move to the US or having moved to the US. How committed are you to the UK?
Look, we are proudly British. We're 170 years old. In fact, we'll celebrate our 170th birthday next year. We've been proudly listed in the UK for many decades now. We, of course, have a secondary listing in the US, and that's served our interests well. And so we're committed to so far, be driving the turnaround plan. But now, as we start a new chapter, we believe we've got the kind of setup that we need to realize our ambitions.
So not changing and just going to the US?
No, we're
access better capital.
We believe with our current structure, primary listing in the U.S., the secondary listing in the U.K. and the secondary listing in the U.S. allows us to access the capital that we need.
Is there anything that the U.K. could do better for companies that are listed?
Look, I think the U.K. has been a good environment for us. Like I said, over the many decades, it's served our interests well. Of course, there's always opportunities that any company or any country can be doing better. But right now, we're focused on what we need to do as a company to drive performance improvement and make the investments that we need. And I believe we've got an environment here to be able to do that.
Thank you so much for joining us. Deepak Nath there, the Chief Executive of Smith & Nephew. Now, coming up, Magnum Ice Cream starts trading in Amsterdam, London and New York in a rare triple listing. So we'll talk, you've guessed it, ice cream. That's next. And this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. China's top leaders make boosting domestic demand their top priority for 2026 as they seek to protect the economy from global trade. ECB policymaker Isabel Schnabel suggests interest rates have reached the bottom, saying she's comfortable with bets that the next rate move will be a hike. Plus, Ukraine's president heads to London as European leaders seek to steer U.S.-led peace talks. President Trump says he's disappointed in Volodymyr Zelenskiy. Now, emerging market currencies are in flux ahead of a busy week for global central banks. EM equities edging higher, supported by improving sentiment around U.S.-China trade relations. Joining us now, James Lord, head of FX and emerging market strategy at Morgan Stanley. James, thank you for joining us. I mean, it is a big week simply because of Fed. So what are you expecting the Fed to do on Wednesday? Is it a done deal that they cut?
We're expecting them to cut. I mean, nothing's ever a done deal until it's done. But with market pricing where it is, it would be a big surprise if the Fed decided not to cut. So we're expecting that 25 basis points to come through. Yeah. We're expecting Chair Powell to essentially make a reasonably hawkish kind of press conference and statement suggesting that future cuts from this point on will be very data dependent. Nothing is set in stone. But ultimately, by the time we get round to the January meeting and the April meeting next year, we are expecting those meetings to result in cuts as well, largely because we expect the data to justify that.
So data, not personality driven because of who's the next Fed chair?
Well, for the time being, the FOMC committee is what it is, and we'll obviously see changes in that next year. But for the next couple of meetings, for this one in January, we do see that cut coming through, and then ultimately in April as well before Chair Powell steps down.
James, what are you expecting overall dollar to do? And then we'll talk a bit about emerging markets and maybe your favorite pairings.
Yeah, so, I mean, this year has been obviously a year of big dollar weakness, particularly in the first half of the year. It's been on pause for the second half. But as we're moving into next year, we do expect to see that weakness coming through again. I mean, it is largely based around the story that we described, more cuts than what the market is currently pricing. And as the Fed delivers those cuts, we expect the market to ultimately price more. So we're quite bullish on the front end of the US Treasury curve. And ultimately, the data as well, we are expecting that to soften over Q4 and in Q1. It's not just a government shutdown story for growth weakness in the fourth quarter. Our economists are also expecting to see high inflation eroding real purchasing power of consumers, that leading to a consumer slowdown and ultimately a weaker dollar as well.
So, Jim, how much does this actually have to do with, some of the policies and the economy where you're seeing, quite a lot of weakness, or at least some weakness that warrants cuts? And how much does this have to do with also proving, investors just moving away from U.S. assets and therefore selling dollar?
Yeah, so I think primarily this is about a traditional business cycle, monetary policy reaction where growth slows, the Fed cuts, the dollar weakens. But clearly there is an element here where we're all talking about who the next Fed chair is going to be. We're all talking about how the regional bank reappointments may go in February. If markets come away from those outcomes with this impression that the Fed is going to be more tolerant of higher inflation going forward, then it will increase incentives to hedge dollar exposure and potentially move to other markets like EM.
So how do you look at EM? Is it really blocks like Latin America versus Asia, or is it individual countries?
I mean,
a little bit of both.
Yeah, I mean, this year you can see pretty clear regional differences in performance. I mean, LATAM and CEMEA have all done pretty well. I mean, it's hard to find currencies in those time zones that haven't done well. In Asia, it's much more of a mixed bag. So you've had Korean won, Indian rupee weakening, you've had Thai baht strength, renminbi strength. It's much more of a diverse kind of range of outcomes. But for CEMEA and LATAM, we've seen very strong performance. And we're expecting that regional preference to largely be maintained because we're expecting risk appetite to be strong, and we're expecting this kind of continued kind of search for yield, increasing in interest in EM, local currency government bond markets by global investors. We're expecting those trends to continue and really favour LATAM and CEMEA. We are expecting some rebound in some of the currencies that have weakened in Asia this year as well, but still it's likely going to underperform the stronger stories that we see elsewhere.
Right. It does feel like the biggest surprise of this year is actually, despite all the trade and tariffs, a lot of the countries and emerging markets did okay. Yeah. Is this because of some of the pain or the structural reform that they've done in the last 5 to 10 years? Yeah,
I think EMs are benefiting generally speaking, they're benefiting from some of the policies that have been put in place, some of the reforms. But I mean, I would say if you had to look at the single most important variable within EM that has driven currency strength, it's been the hawkishness of monetary policy. Yeah. So if you look at in Brazil, you look at Hungary, you look at Turkey, you've seen a lot of the markets where you've had the strongest FX performance has been from those markets where you've had a very strong anchor from monetary policy. And so when you put that against what we just described about the Fed, there's a clear kind of tension or differential in the rate kind of dynamics that are putting upward pressure on these currencies.
In Asia, I mean, a lot has to do with what happens to China. And we had a good story today saying, look, is there going to be stimulus in 2026? They're trying to definitely stimulate some of the domestic demand. How do you see China panning out?
So, I mean, growth we're expecting to be a kind of around a 5 handle for next year, but there's clearly some softness in some of the current indicators. When you look at investment, retail sales, it's all reasonably soft. So we're expecting some rate cuts to come through next year and a little bit of fiscal support as well, but nothing that's going to drive a significant upswing. China's going to remain in deflation, and that will maintain kind of export the export competitiveness will be intact, but we're not expecting some big growth upswing that causes significant amounts of capital inflow and therefore currency strength. The currency will remain very low volatility. When you look at implied vol on dollar renminbi, it's close to 2%. I mean, it's on an annualized basis. It's become a very, very low vol currency. And so when we're in a bearish dollar environment, there are probably other currencies that are going to be outperforming the renminbi.
In the region?
In the region, but also around the world. I mean, in the region, we're expecting Korean won to rebound. It's obviously had a very weak 2025. But now that the Bank of Korea, we think, is basically done with the easing cycle, and that as U.S. growth next year, we're a bit soft on U.S. growth for Q4 and Q1, but as the next year accelerates with stronger growth, we expect the kind of domestic demand and the capex cycle that we're seeing out of the US to really benefit countries like Korea. So a broadening out of Korea's export cycle that will ultimately cause the Korean won to rebound.
Thank you so much, James, for joining us today. There's a lot to unpack. What's your craziest thought for 2026? Do you have like an outlier call?
I don't think we have super crazy thoughts at Morgan Stanley, really. But, I mean, it'd be interesting to see how the Brazil market opens today because of all of the vol that we saw on Friday. I mean, I'm expecting eventually that BRL will rebound because, the BCB is going to be quite hawkish, quite sensitive about volatility ahead of the election. And as I said before, like hawkish central banks, like you want to be buying into those currencies.
James, thank you. James Lord, head of FX and emerging market strategy at Morgan Stanley. Now, the ECB's Isabel Schnabel is comfortable with bets of an interest rate hike, warning of risks to the economy and inflation. The central bank's last batch of forecasts suggests that growth would slow to 1% next year before picking up again in 2027. Well, let's bring in Bloomberg's Jana Randau. Jana, this was a great interview. Congratulations to you and the team. What's your take on Schnabel's comments?
Yeah, we were a bit surprised about the hawkish nature. Of course, we knew that she has these thoughts, but hearing her being so clear about the next step potentially being, or very likely being a hike, albeit not anytime soon, that was definitely news that we did not quite expect out of her mouth. What's surprising, really, underlying this expectation is the relatively optimistic economic outlook she has. So she's arguing that, core inflation, the slowdown we've seen over the past couple of months has come to a halt. Core inflation, of course, is at around 2.5%, slightly higher than the ECB would like to see. At a time when the economy is starting to pick up, at a time when the output gap is closing, at a time when fiscal policy will offer stimulus. Remember the investment packages for infrastructure and defense spending. And she sees price pressures there. She sees, risks to the upside on inflation, for growth as well, which she says will probably have to be reflected in the projections coming up. So overall, a very optimistic take on the economy from Isabel Schnabel there, in contrast to some of her colleagues, of course. Yeah. So, we're hoping for an interesting meeting. Yeah.
Yeah, I mean, it's quite incredible, right? She's the first one to actually not say that interest rates are in a good place, but she's actually put a floor, that this is a floor. Is it dangerous because then market expectations kind of change?
I don't think so. I mean, she also said interest rates are in a good place for now. So she doesn't expect those to change for quite some time. She was very clear on that. But she did mention market expectations. She did mention economist expectations for a rate hike down toward the end of the horizon. So not next week, not next month, potentially not even next year. But the bias is there. And then, data will tell.
So interesting. Such a great interview. Jana, thank you. Jana Randau there from the ECB team. Now, the world's largest ice cream maker has jumped in its debut in London and Amsterdam and will begin trading in New York later in this rare triple listing. Magnum Ice Cream Company, a spin-off from consumer giant Unilever, is debuting a month later than initially planned after the U.S. government shutdown delayed its listing. Well, Bloomberg's Charlotte Hughes-Morgan joins us now from Amsterdam on the story. Charlotte, I mean, the newsroom is all in a tizzy. Are you like team white chocolate or almond, or are you, dark chocolate? But how might investors be interpreting the company's trading debut?
That's a very good point. It's a very exciting day. Magnum finally debuting on Amsterdam, New York, and London this morning. So at the open, so in Amsterdam, Magnum is valued at 7.8 billion euros. That's 12 euros 20 cents per share. And as you mentioned, it has risen since the open. That opening is slightly lower than the kind of technical reference price that was set. But when we speak to people in the market, they're saying, look, this is kind of in the range we're expecting. Jefferies analysts saying this is bang in the middle of what they were expecting. Some saying, they'd hope for a bit higher. But really, what we're seeing at the moment, it really is, in the short term, a wait-and-see game with Magnum. There is a lot going on here. It's a very complex listing. It's not a capital raise. It's not an IPO. So what actually happened is Unilever shareholders, for every 5 Unilever shares they owned, they automatically received 1 Magnum share. And, some of those bigger investors, these are 2 actually very different companies. You've got one pure play ice cream company, and Unilever, this big kind of personal health food giant. So some of those investors, Magnum doesn't fit in their portfolios anymore. It's Netherlands domiciled. It's not going to be in the FTSE 100. So what we've seen is a bit of kind of forced selling, likely at this opening stage. And, the market is saying, OK, it could be a few more days. It could even be next week that we get a more stable price, that we're able to really see what that valuation is. It's also one of the only, if not the only, pure play listed ice cream company. So the peer group is quite a tough one to discern. They're kind of situating themselves in the snack refreshments, but it's quite hard to tell at this stage.
So, Charlotte, what does this demerger mean for Unilever?
So Unilever is saying, look, the ice cream company is the ice cream business, very capital intensive. Storing and distributing frozen products is, requires a lot of capital. It's also obviously a very seasonal business, ice cream. So without the ice cream business, Unilever is saying we'll be able to focus on our kind of core areas of personal health, beauty, our other food business. The CEO has said actually, ice cream kind of didn't fit with our portfolio. And on the Magnum side, Magnum is saying, freed from Unilever, we'll be able to allocate capital, to the best advantage for the very kind of unique business of ice cream. So both parts of the business are saying, look, we're free to go our own way, focus on, the areas of the business that are really important to us.
Charlotte, thank you so much. Charlotte Hughes-Morgan there on Magnum. Now, PIMCO's chief investment officer has emphasized the importance of doing work, your own credit work, as part of a discussion on inflated credit ratings and private credit. Dan Ivinson has been speaking to Bloomberg's Odd Lots podcast on its 10th anniversary.
It is very, very dangerous to assume something has an investment grade rating just because the rating agencies assign a rating to it. It's critically important that you do your own credit work. Today, all too frequently, you'll have an investment grade rating from one entity. And again, market participants for years have always joked, if you can only find one investment grade rating, it's pretty fair to assume everyone else is below investment grade.
And you can catch more of that interview in the full episode of Odd Lots, which has just launched. Find it wherever you get your podcast. Now, coming up, President Trump chides Ukraine for its response to a proposed peace plan as the UK prepares to host European leaders. More on that next. And this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the UK Prime Minister Keir Starmer will host Ukraine's president and other European leaders today to discuss US-led peace talks between Kyiv and Moscow. It comes as President Trump expressed dismay with Volodymyr Zelenskyy's handling of a US proposed framework to end Russia's war in Ukraine.
We've been speaking to President Putin, and we've been speaking to Ukrainian leaders, including President Zelensky. And I have to say that I'm a little bit disappointed that President Zelensky hasn't yet read the proposal. That was as of a few hours ago.
Well, joining us now is Bloomberg's chief Europe correspondent Oliver Crook in Brussels. Ollie, there's been little indication of a major breakthrough. What do we actually expect to come from these peace discussions?
That's right. There's been no shortage of negotiation over the last couple of days, really beginning with Friday, where you had the Ukrainian delegation speaking with the U.S. delegation in Florida. And they said, kind of in a joint statement after that, that they've developed a framework of security arrangements. And this is obviously, remember, one of the main sticking points of security arrangements for the day after in Ukraine. But that's not clear in terms of what the actual the details of that is, if this is just a sort of effort to keep momentum in the discussions. We also understand that Zelensky spoke with Mr. Witkoff and Kushner on Saturday. And there you heard President Trump saying that basically Zelensky had not been fully briefed on the proposal. We expect Zelensky to receive that briefing from those discussions in Miami a little bit later today, in addition to a meeting with President Zelensky, with Keir Starmer, Emmanuel Macron, and Friedrich Merz. We should say that with these sort of meetings at the high level of European leaders, they very seldom have generated anything really concrete. There's a lot of behind closed doors discussions, but it doesn't tend to be sort of breakthrough formats. I think this week, Francine, what we're really looking forward to is looking at basically the Russian position. Are they going to fully endorse this peace process yet? Remember, they've been much more guarded than the Trump administration has been throughout. And then, of course, this question of the frozen assets within Europe. There's basically a week and a half left before the EU leaders meeting next week. If European leaders do not make an aggressive move on this over the next couple of weeks, really within the next sort of 11 days or so, this may not happen at all. So I think those are the main key points to watch out for over the coming days.
Trump's approach to Russia-Ukraine is part of a broader U.S. foreign policy, which the White House articulated on Friday. It doesn't seem like it's good news for Europe, Ali.
I think that's a pretty fair assessment, Francine, and I think that anyone reading this document, as I've been doing this morning, would come to that very same conclusion. I think the main point that we're getting from the document more broadly is what they're calling it the Trump corollary to the Monroe Doctrine, which is basically a U.S. foreign policy posture that basically wants to focus exclusively or majoritarily on the Western Hemisphere, basically wants to end the Russia-Ukraine war, and basically wants the Europeans to take care of their own situation. Now, that is something that we've heard from the Trump administration many, many times before, but this is sort of formalizing it in a way that we haven't really seen before in a single document. And there are a couple other things here, Francine, that I'll quote for you that I think will be very concerning to those that are here in Brussels, saying that basically that Europe is, the continent faces civilizational erasure, and that the United States would like to cultivate resistance to Europe's current trajectory within European nations, saying that they'd like to encourage patriotic European parties within the European system, and especially those that are combating what they call loss of national identity, which is, a sort of one of the terms we hear a lot from J.D. Vance and many on the right in the United States. But I think more prominently within this discussion, they talk about NATO, and they say that in the next couple of decades, potentially these European nations may be so filled with so-called non-Europeans that they may not be interested in honoring the initial spirit that brought NATO together. So, of course, that will be very concerning to the Europeans watching very closely. And, of course, we should say there's also a self-interest side for the United States. More nationalism within Europe is a less unified EU, which makes it less coherent in terms of negotiating on big issues with the U.S. like trade.
Ollie, thanks so much. Bloomberg's chief Europe correspondent Oliver Crook. Now, for more on this, we're joined by Natia Seskuria, International Security Associate Fellow at RUSI. Natia, thank you for joining us. I mean, if you're Europe right now, you're trying to look at the document that the White House put out on Friday. I guess you're worried. You're worried about security. You're worried about defense. And you're just worried about the allyship. What does this mean for Europe?
Thank you very much for having me, first of all. I think it is very concerning indeed, because we see the U.S. changing its face. U.S. is no longer the traditional ally that Europe has known for a very long time. And of course, the main question is to what extent there will be some tangible progress when it comes to peace in Ukraine, because this will ultimately reflect on European security in the future.
But Natia, so what do we know that, Vladimir Putin wants? At the moment, he hasn't really said that he'd even go behind this plan. And so it's unclear why the U.S. keeps on pushing it so hard.
I believe Vladimir Putin does not want to achieve peace in Ukraine. And even when it comes to the 28-point plan, which was very much in favor to Russia's interest, I do think that Putin still believes that he can fight this war and he can achieve battlefield successes. Hence, I do think that Vladimir Putin is unwilling to accept any concessions when it comes to his territorial claims, as well as Ukraine's future as a demilitarized state as he sees it.
So what does it mean going forward? Why is the U.S. It's unclear to me, actually, the relationship that Volodymyr Zelenskiy has with Donald Trump right now.
It is a very difficult relationship. I think Volodymyr Zelenskiy has a very difficult task to somehow change the U.S. positioning, which has been more or less clear, because President Trump wants to end this war as soon as possible, and he does not care much about what sort of outcome will be there in Ukraine in terms of Ukraine's future prospects as a sovereign and independent state. So this is most concerning part from President Zelensky, who is unwilling to make concessions when it comes to his country's sovereignty.
I mean, can Europe go at this alone? There's a problem of money. There's a problem of weapons. I know Volodymyr Zelenskiy is being, greeted today by Keir Starmer with other EU leaders. But what can Europe do if the U.S. doesn't involve them that much?
I think Europe has a very important role in here because, of course, Volodymyr Zelenskiy will rely mostly on European allies. And I think it was articulated very well in the U.S. official positioning that U.S. sees Ukraine war as Europe's problem to deal with.
When you look at what we've seen, the optics of last week with Vladimir Putin showing up in India, when we have Wang Yi's visit to Moscow, giving this diplomatic spook to Russia, is Russia slowly being accepted back on the diplomatic front worldwide?
I think it's early to say so, but Russia has its traditional allies. And I think with the recent diplomatic visits and exchanges, Vladimir Putin is trying to send a message that regardless of the Western isolation of Russia, he still has powerful allies. And of course, India and China are very important for Russia's economic lifeline. So in that sense, I think he's sending a message to the West as well that he's capable of continuing this war effort in a long-term perspective.
So what can Europe do?
Frozen assets, I think this will be one of the main areas of discussion, and Europe needs to make a decision over this issue that has been much discussed over the past years, and of course scaling up the military support to Ukraine, because I think the battlefield, when it comes to the battlefield, that is one of the most crucial parts of this war.
But Natia, we understand through Bloomberg reporting that actually certain U.S. officials have been briefing European country heads not to use the frozen assets. Is this because of monetary deals with the U.S.?
Well, the U.S. has a very ambiguous, very confusing standing when it comes to Ukraine. And I think because Europe will be the main actor dealing with the Ukraine war, I think in a way Europe needs to make a sovereign decision over this issue, because this will be crucial for Ukraine. And I think any ambiguity over this gives an upper hand to Vladimir Putin.
But how long can Ukraine last without U.S. government support?
It depends how much Europe is willing to support Ukraine. And I think there is still a potential for Europe to scale up the military and financial support to Ukraine. It will be very difficult, of course, because U.S. has been one of the main providers when it comes to intelligence, military support. But I think there is still a space for Europe to play a very important role and scale up this support for Ukraine.
So how do you see the next 6 months developing? I know this is a very difficult situation, given there's been so much upheaval also in the last 2 weeks. But what's your main prediction?
I'm not expecting that there will be any progress, any tangible progress, or any peace deal signed anytime soon. I think this process will be stalled pretty much. There will be negotiations back and forth, but I think ultimately, whatever the deal will look like, Vladimir Putin will be unwilling to accept concessions. So I'm expecting, unfortunately, that the war will continue and Ukraine would need crucial support on the battlefield.
Is it difficult to see what happens on the battlefield?
It is difficult because Russians have been advancing slowly, and of course winter is coming, winter is here, so the advances will be even slower during this time. But I think Ukraine and Ukraine's allies need to look further, and when it comes to spring, summer, Ukraine would need very much tangible support to make any advances on the battlefield or defend itself against the further Russian aggression.
Natia, thank you so much for joining us. Natia Seskuria, their International Security Associate Fellow at RUSI. Up next, Bloomberg Brief. I know the focus today will definitely be on that ECB scoop on Isabel Schnabel, the Executive Board member, saying she's comfortable with investor bets, actually, that the ECB's next interest rate move will be an increase. The other story is the Fed on Wednesday. So we'll have a full roundup of all of the market moves shortly. This is Bloomberg.